What's up, guys? Here is the second half of the earnings call, which will be consisting of the investor questions.
And with that, I'd like to thank you all for listening and hand over to the moderator for Q&A.
Thank you, ladies and gentlemen. Just a reminder, if you wish to ask a question, please press star and 1 on your telephone keypad. If you wish to cancel your request, please press the hash key. Once again, it is star and 1 if you wish to ask a question. And the first question comes from the line from Andrew Golan from Berenberg. Your line is now open.
Oh, hi, thanks. Good morning, everyone. And welcome panel. Two questions, please. First one's on the concession payments issue. So what is the expected benefit to free cash flow this year from the deferred payments on the Trent 1000? And compared to your assumption when you first guided to a free cash outflow of 2 billion. And I guess effectively, is it just an offset to the lower than hopes engine flying hours? So that's the first question. Second question on fleet exposure. So pre-COVID, can you say what the percentage of engine flying hours were from Asia Pacific, ex-China? And given the slow progress of vaccinations there, what are your expectations for flight hours in that region in 2022, please? Thank you.
Yeah. Okay. Do you want to go the concession payments?
Yeah. I will do. Thank you. Thanks, Warren. And morning, everybody. Delighted to be here for my first set of results. I guess, Andrew, what I would say when I look at full year guidance, and one of the things that struck me as I came into the business was this is a very broad-based group with 3 businesses in it, and there are a number of variables, both some in our control and some not in our control when we look at that full year guidance. We've reiterated the 2 billion outflow this year. There are definitely some ups and downs within that. You've mentioned concessions. There are some concessions that could go out, and there are indeed some that could come back in. So there is some variability there. There is, I guess, a hedge within that around recovering engine flying hours as well. So when I look across the whole group, we're comfortable in reiterating that guidance for this year. When I look at each of the variables, particularly the ones that are in our control, we've sort of highlighted the benefits that we're getting from the cost measures and the restructuring that we've already taken within the group. In terms of fleet exposure around those details, one thing I'd highlight, and you've talked about China in particular, we have seen a recovery in domestic flying hours back to 2019 levels, and we know there is a significant part of that comes from Chinese domestic flight.
Yeah, I think the answer on the regional piece is that yes, we do have an exposure in Asia, and our big customers, Cathay and Singapore, are clearly sort of facing reduction compared with where they were pre-COVID. As Panos says, we can see the underlying demand in that region from the domestic travel in China, and it is just a question of how quickly borders can open, and that's a question of how quickly vaccination rates can get to a level to have significant proportions of the population vaccinated. And clearly that's one of the contributory factors to what we're seeing as a very slow and gradual improvement in our overall engine flying hours. To answer specifically around the proportions, then it's approximately 20% of 2019 levels of engine flying hours that are exposed to international flights in that part of the world.
Thanks. If I could just follow up quickly on the concession payments answer. So if we simply break it down, I mean, at one point we were talking around a target of 750 million free cash flow at 80% engine flying hours. And if we assume a sensitivity of 300 million or so per 10 points, so if we take a step down on that engine flying hours assumption of 10 or 20 points, say, and then add in a headwind from concession payments catching up, does that indicate a scenario that we could be closer to break-even free cash flow in 2022, or is that just too simplistic?
I think it's a bit too granular, and no, we're on a clear trajectory here. I mean, last year's cash outflow we know was over £4 billion. This year we're sticking to a cash outflow of around £2 billion. We are sticking with our comments of going through to reaching cash positive at some stage during the second half of this year, and we'll be coming out with some specific guidance on cash for 2022 when we do our full year results. But we absolutely expect to be in positive cash territory by some margin.
Okay, great. That's very helpful. Thank you.
Thank you. The next question comes from the line from Robert Stallard from Vertical Research. Your line is now open.
Thanks so much. Good morning.
Good morning.
A couple from me. First of all, obviously been a lot of reports of older aircraft being retired and their engines being retired as well. I was wondering if you'd seen any impact as a result of parting out of older wide-body aircraft in the first half that was any different from what you saw in the second half of last year. And then on the business jet side, the Gulfstream G700 with the Pearl engine, are you seeing any additional challenges in getting that engine certified? Thank you.
Well, no particular changes to the patterns that we've seen on retirements of older aircraft in the first half of this year versus what we saw in the second half of last year, really. I mean, and as far as our fleet's concerned, obviously this impacts things like the RB211s and the Trent 800s. We've got specifics around Trent 900s on 380s, where some of those much larger aircraft have been parked. I think the thing looking forward for us is how quickly the A330s that have been parked return to service. And if we look there, we were coming into the pandemic the sort of de facto market leader in terms of share, and that had been a relatively recent, i.e. sort of last 5 to 8 years phenomenon, and therefore our engines are significantly newer, and so we would expect that the younger engines on the Rolls-Royce powered A330s are the ones that will be favoured when those A330s go back into service. On the Gulfstream and the new program that we're doing there are no particular extra challenges with certifying that engine at the moment.
Okay, that's very helpful. Thank you.
Thank you. The next question comes from the line from Jeremy Bragg from Redburn. Your line is now open.
Good morning, gentlemen. Couple of questions, please. First one on the break-even rate for engine flight hours for free cash flow. So, sorry, I'll put that a bit better. You're aiming to break even from a free cash flow perspective at some point in the second half of this year, and would you be able to state the engine flight hours required to do that, please? Second question on engine flight hours again. When do you think you will return to 2019 levels, roughly? And that's obviously the net of retirements and deliveries, but I guess where I'm going here is you've taken a third of costs out structurally in civil, so I'm just kind of curious to sort of see your view of when that recovery point is, please. And then the third question, if I may, please, around R&D. I note that you're spending 75% of gross R&D on sustainable technologies from now. Have you revised your assumptions on the self-funded R&D that you might spend over the next few years, please? And do you still think there is a route to market for UltraFan, given the lack of any new wide-body platforms? Thank you.
Yeah, righto. Panos is going to have a first question.
Let me pick up on your first question around break-even, Jeremy. I think as I mentioned earlier on, there are a number of ups and downs and variables that contribute to our results. Engine flying hours, as you rightly pointed out, is one of them. That's not one that's within our control. When we reiterated the guidance for this year, that 2 billion outflow and that positive at some point within the second half, we do look at all of those variables, the impact of the restructuring, some of the headwinds that we had in the first half of this year, which we've called out. When I put all of those in the mix, that's how we get confident that we will get through that break-even rate this year. In terms of the forecast going forward, when do we get to 2019 levels? There are a lot of industry forecasts out there as to that we can look at, you can look at, and rather than just us adding our own, I'd encourage everyone to look at what the wider industry forecasts are.
Okay.
On that though, Panos, sorry to interrupt. I mean, we can look at the industry forecast, but you've always been quite assertive in the past that you've got a younger and better positioned fleet than the industry on average. So I'm guessing you must have your own separate view on that, please.
We do, and I think you can look historically how we have tracked against those industry forecasts, and I wouldn't expect us to be out of line with those industry forecasts.
Okay, thank you.
Yeah, and again, industry forecasts are not very different from our own expectations of getting back to 2019 levels. And I think we've been fairly consistent that is some way off, probably in the sort of 2024, maybe even 2025 time frame. We're going to see, we will see a pickup when international travel opens. The demand that we're seeing where it has opened is a good indicator that there's plenty of demand there. So we can't be any more clairvoyant than anyone else. It's a few years away before we get back to 2019 levels, and that's an indication of the changed behaviour that everybody talks about around travel. On R&D, then there's no big change to the absolute quantum that we've talked about before. I think what you are seeing in some of our commentary, though, is a tilt towards net zero and lower carbon, and an intention to push that up over the next several years to be 75% of our R&D investments and CapEx investments, and that is a process that we're going through at the moment. Fairly disciplined capital allocation over the next 5-year period.
Thank you.
Well, I think that's about it really on this answer.
Thanks very much, both. Thank you.
Thank you. The next question comes from the line from Ben Heelan from the Bank of America. Your line is now open.
Yes, morning, and thanks for taking my question. I had two. The first one, you highlighted you're making good progress on the disposals, and you said there's not much incremental you can give on those processes. I was wondering if you could give any indication about how you think about the impact to that £750 million of targeted free cash flow when you finally have disposed of those businesses. So that would be the first question. And then the second question, back on the concessions point, because at the very beginning of the year, we were expecting a massive outflow, in particular from 787 concessions. And I think, Panos, you mentioned about 300 million outflow in H1. Are you expecting an outflow on 787 concessions in the second half of the year? Thank you.
So I think your first question was around disposals and the impact of those disposals on free cash flow. It's not a significant impact, and you can see actually within our announcement where ITP is stripped out, so you can see that it's not a significant number. In terms of the concession payments, we are dependent on airframer deliveries, and as you know, that there are some well-documented uncertainties around that. We do still expect to see an outflow. Some could move out, some could move earlier. But we took those into consideration when we looked at full year outturn on the 2 billion outflow.
Okay, thank you.
Thank you. The next question comes from the line from David Perry from JP Morgan. Your line is now open.
Yes, hello, Panos. I have two questions for you, if that's okay. First one is sort of philosophical on the balance sheet, which you've mentioned you want to improve, and you mentioned specifically that 3 billion of net debt is too high. But that's a very narrow definition of your net debt. It excludes operating leases and a lot of other financial liabilities that may or may not be treated as debt in your eyes. So I'd just be interested in how you see the balance sheet in the round. And then the second part of that question, if the ITP disposal happens, what you think the next steps are, whether they can be wholly organic or other external actions might be needed. And then my second question, please, is you talked about wanting to simplify financial reporting, but I think your three predecessors all had the same ambition as well. And my view is probably the business model is just too complex. So the question for you is, are you comfortable with the LTSA business model, or do you think Rolls needs to move away from that to achieve your goal of more simplified reporting? Thank you very much.
Thanks, David. I think on balance sheet, I think you heard in the comments that I made earlier on, an ambition that we have in the medium term to get back to investment grade credit profile. Lots of liquidity at present, so that 7.5 billion of liquidity that we've got at the moment means that we can do that in a measured way and make sure that we invest wisely at the same time. Just to pick up on one of Warren's comments earlier on, I recognise the point around other liabilities in the balance sheet. You consider all of those in the round when you're looking at getting back to that investment grade credit profile. I think also it's going to be important as we look at the shape of the business going forward, and as a more balanced business going forward, the gearing within the business may well look different to how it's looked in the past. So it's another consideration that you need to have. I think in terms of your second point around ITP disposal, I'd reiterate the point around liquidity. Liquidity is there. There is plenty of liquidity. We're not dependent on engine flying hours recovering. So I don't see the need for any other non-organic, I think, measures. In terms of financial reporting and your point around the business model, I'm comfortable with the business model. It's a smart business model. In fact, many businesses that I've worked with in the past would love to have a business model where you have your customers being effectively so sticky, and then you can work hard on making sure you deliver at a sensible cost. Does that, I think your comment there was, does that contribute to the complexity of financial reporting? No. I think spending time, and I have spent a lot of time now, understanding the underlying business drivers. The underlying business drivers are straightforward once I spend some time. It's now how we make sure we translate that into a way that the outside world can understand in a more straightforward way.
Well, good luck with it, and look forward to meeting you next week.
Thank you.
Thank you. The next question comes from the line from George Chow from Bernstein. Your line is now open.
Hi, good morning, everyone.
Good morning.
We talked a lot about engine flying hours, so I want to focus on pricing. So on flight hour contracts, compared to the start of the year, have you seen any major changes in the trends around these prices when engines change hands or when new contracts are signed? And second question, a quick one, what proportion of the large engines are deployed on domestic routes today, and do you think that's sustainable?
Yeah. Engine or long-term service agreement pricing, our basic pricing model hasn't changed. Clearly, we have been engaged during this time where airlines have been restructuring, filing for bankruptcy and coming out of bankruptcy, restructuring. There's been new contracts to strike. And I would say there's been a mix there where we have, and I think we mentioned this at our previous results, we've been working with customers to accommodate some of their short-term financial challenges in the normal way of a commercial negotiation that generally involves something on the other side. And so, that might manifest itself in terms of a period of lower per hour rates at given types of usage of an engine, compensated by higher rates a little way down the road. And so sort of normal warp and weft of commercial negotiations have happened there. In terms of a normally moving from one owner to a second owner, then the principle that we quite often secure higher rates on that transition, that's actually held up remarkably well during this period. On your second question about domestic and large engines used on domestic, we have two areas. North America, we have some older engines that are used domestically, and in China we see a lot of wide bodies used domestically, and then case by case different airlines have parts of their fleet with wide body engines used domestically, and Japan's a good example of that with both ANA and JAL. And all in all, domestic use was about 10% of our total pre-COVID number in 2019. And obviously it's a bit greater now as the sort of traditional long-range international stuff has fallen away. But I would see upward pressure because regions like China in particular and in Japan, we can see large numbers of people traveling short distances, and airlines are using large wide-body jets to do that. And so, I think the 10% is probably a floor, and the 20 to 25% that we're seeing today is probably a bit too high for long-term sustainable, and the answer is somewhere in between.
And George, just something I'd probably add on the pricing point, and you can see it in the half-year numbers where we've got some long-term contract catch-ups, which are the result of some of those commercial negotiations. So I'm a big believer in us being rewarded for the value that we bring, and we recognise that within the long-term contracts when we've got that value. So you can see some of that upward gain around those commercial negotiations coming through there.
Okay, great, thanks.
Thank you. The next question comes from the line from Chris Hallam from Goldman Sachs. Your line is now open.
Yeah, morning everybody. So just three questions from me. Warren, perhaps first on strategy. There's no mention of hydrogen or absolute zero on your 2050 emissions slide, and that's obviously a bit different to what some of the aircraft manufacturers are saying. So is that a different view of the future, or do you expect to play a smaller role in propulsion if the industry does eventually partly transition to hydrogen? Second, perhaps for Panos on EFH payments. Can you give us an idea just on how predictable those payments are? Because I think most of them are done annually in relation to the coming year. So how difficult is it to firm up the level of those payments given the uncertainty on the shape of the recovery and our customers paying on time? And then finally, just on free cash flow phasing, you've said you'll move to positive free cash flow at some point in H2. There's obviously a lot of seasonality in the business, but there's also the gradual EFH recovery and the savings benefits is kicking in. So should we sort of be assuming that H1 next year is better than H2 this year, and then H2 22 is better than H1 22?
Okay, Chris, let me just answer your first question. I'll also have a go at that second one. I think the simple answer is hydrogen is included in inverted commas new technologies on that slide. I did mention in the presentation that we haven't really got time this morning to discuss that slide in a lot of detail, and there is a huge amount of detail behind that slide. Hydrogen will play its part in lots of different sectors. It's probably less likely to play a part in long distance international travel than there'll be shorter distance, smaller aeroplane place for hydrogen to play. That's what we're currently believing, but it's very much part of our piece, and you should have a look at our net zero report that's on the internet that we launched a few weeks ago.
And then in your other two questions on engine flying hour payments, no particular concerns around customers being able to pay. They're paying on time as we'd expect. In terms of the pattern of those, mostly the payments are based on hours flown. Occasionally some pay based on shop visits, but again that is relatively predictable, subject to engine flying hours actually being flown, as we said earlier on. In terms of your seasonality point, you're right. We maintain cash flow positive as we go through the second half of this year at some point. When you're looking at next year, think of that upward trend continuing for the course of the whole year. So the full year impact of the restructuring benefits coming through, the 1.3 billion run rate we've talked about, the recovery in engine flying hours, power systems, we called out the increase in the order book, that starts turning into revenue and then cash as you go through next year. Defence remains resilient, and the underlying seasonality that you refer to that you've seen over past years, you should expect that to remain, with the second half of the year being the more positive compared to the first half of the year.
Okay, very helpful. Thank you.
Thank you. The next question comes from the line from Andrew Humphrey from Morgan Stanley. Your line is now open.
Hello, good morning, and thanks for taking my question. I've got a couple, if I may. One is on civil aerospace profitability in the first 6 months. Panos, you mentioned positive contract catch-ups in the period, but it also looked to me as though the underlying performance, the clean performance on civil aero gross profitability was stronger than maybe was reflected in consensus. I wanted to ask if there was anything specific in the mix, either in terms of engines coming in for service or in terms of customers that would flatter that in this period. And secondly, maybe one for Warren. We've obviously had confirmation of an A350 freighter entry into service 2025. I wanted to ask you about how you're assessing the opportunity there in terms of any additional capacity you may need to make available.
Yeah, so let me pick up on the civil aerospace profitability. So nothing specific in the mix to call out there around the underlying. The other point I'm sort of curious about is around contract catch-ups. So sometimes when I see commentary on them, they're sort of viewed as something to ignore or to overlook. The reason those contract catch-ups are there, and they're positive contract catch-ups, is twofold. One I've already mentioned. So when commercial negotiations, we've been robust and we see that being baked in as a benefit. So it means the long-term contract as a whole is going to have a greater margin because of that, and this is the catch-up to recognise that. And the other element we've called out there is the cost savings that are now baked in. So we plan for cost savings, but we don't recognise them until we are sure of them and they start to flow through. And I think that particularly within business aviation, those kind of catch-ups are going through. So I recognise that we're looking at a 6-month period, but I tend to look at long-term contracts as long-term contracts and what's happening to the margin of those contracts over their life. And those catch-ups represent an increase in margin over life.
And to your question on the A350 freighter, obviously that announcement from Airbus has been a little while coming, and we're delighted with that. It's a very welcome pull forward as far as we're concerned of growth in demand for our engines. We won't need to worry about any incremental capacity. I mean, don't forget we essentially have capacity for about 500 new large engines per annum, and that's the rate that we were delivering at in 2019. Yes, we've been doing some consolidation of our facilities, but it's very much a consolidation activity, and we would expect to be able to scale up again later in the decade when demand returns without having to move on and open new factories and that sort of thing because of the huge productivity improvements that have been baked in. So we don't need to invest in any additional capacity, but the A350 freight is a welcome sign.
Very clear. Thank you very much.
Thank you. Your next question comes from the line from Nick Cunningham from Agency Partners. Your line is now open.
Hi, thank you very much. Yes, having dealt with a lot of detail, perhaps one could ask a more general question looking forward. I think thinking past the crisis, you wanted to reduce your costs to the point that Rolls-Royce civil aero engines became intrinsically adequately profitable, which it hasn't been in the past. And so what I want to ask is, well, what would adequately profitable look like? How would one measure that? And given what you know about your costs and future overhauls and so on, when we get to, say, 2024, 2025, we get to 100% of 2019 EFH, would you then be adequately profitable on that basis? And then a second longer-term question, slightly longer even than that. Sustainable fuel, I think, is a sort of linchpin of your plan for zero carbon, and clearly very important in that it enables you to stick with your existing technologies to a great extent. What's your assumption about how competitive SAF can be relative to fossil fuel costs? And do you have to assume some tax, if you like, concessions for SAF and a carbon tax on hydrocarbon fuels in order to make that work? Thank you.
Yeah. Well, in terms of our ambitions for profitability in civil, then we've been working on improvements in productivity in civil and cost out in civil for a while. The restructuring that we've been through the process of implementing over the last 12 months, and by the way, we have a little bit further to go yet because this consolidation of 11 sites going down to 6, that's not actually complete until the back end of next year and possibly even a little into 2023 for some of those sites. So, we're not quite done yet, but the heavy lifting has been done on that. And, then we will have, and I've referred to it as in the presentation as a better break even and better gearing as demand returns. And, that will, we believe, take us into a competitive zone in terms of profitability for our civil large engine business. And, that would be, certainly in the mid-teens. As far as SAFs are concerned, and looking forward to net zero, this isn't a Rolls-Royce thing. This is an industry thing. for long-distance international travel, the industry doesn't see a technology solution that's appropriate other than synthetic aviation fuel. For shorter distance, smaller aircraft, then full electrification, hybrids, hydrogen, all of these sorts of alternative technologies have their role to play. But in the long distance wide body space, then it's going to be SAF. Now the good news is, of course, that things like our small modular nuclear reactors, are very useful in terms of zero carbon electricity, because large scale SAF production requires large scale green electricity. But that electricity can also be used for things like hydrogen, as I mentioned. The cost of SAF at scale, we believe, will be approximately twice the fossil fuel equivalent that the fossil fuel has at the moment. Now, that's a little bit of a sort of industry guess. That isn't a Rolls-Royce guess. It's an industry expectation at the moment. And that's why it's important that we introduce things like the UltraFan new architecture to have a step function in efficiency to help our airline customers be able to adopt that. And you might have seen some of the airlines working on their cost projections and you know how they're deeming that SAF will be affordable.
And Nick, I'll probably just add on the first point around profitability. Again, coming in, I look across at a better balanced group now, and I look at defence and power systems and the opportunities there, the resilience and opportunities from energy transition, and push hard around what those margins should be to be competitive within the marketplace. So I don't just look at civil. I want to make sure that we are looking across the whole business and shining a light across each of the businesses.
Thank you, and very, very full answers, for which I'm grateful. But just to clarify on the, if you like, adequate profitability, mid-teens would apply to civil and to the group, or would you see a mix? Is there an intrinsic mix of margin across the different businesses?
There's going to be a mix.
Thank you.
Thank you. The next question comes from the line from Harry Reid from Stifel. Your line's now open.
Yes, good morning, Warren and panels. It's Harry Breach here. Could I possibly just ask maybe 3 questions, if I could? Just back in March, I think you guys said you were expecting large engine shop visits this year, I think about 240, and then 400 next year. And, you know, I guess over the last few years, you know, those large engine shop visits have been, you know, a key indicator for us to try and model the business. So it's very helpful if we can have, you know, some sense of where they're heading. You've done 92 in the first half. I guess that leaves about 148 in the second. Is 240 still the expectation for this year and 400 next year? Maybe secondly, guys, we almost don't talk about time and materials aftermarket revenue at civil anymore. But just trying to look at the financials, it looks as if, looking at the analysis of aftermarket revenues recognised at a point in time for civil, it looks as if it was down really quite steeply. I think 193 million is the number, if I've read it correctly, for the first half of 21 versus 746 in the first half of last year. Can you help me? Maybe I've made another silly mistake, but can you help me to understand whether T&M, you know, has fallen significantly and what the sort of drivers are? And then finally, you know, Warren, I guess again in the past pre-COVID, we used to talk about when across the portfolio, original equipment unit losses would get through break even, and obviously last year was heavily disrupted with a lot of rescheduling of production plans, and it wasn't a meaningful number. But can you give us some idea, Warren, about when you think we'll get through break even in terms of original equipment unit losses? Thank you.
Okay. I think we're going to have to answer these questions quite quickly.
Let me just rattle through the first couple. I think shop visits, it's obviously dependent on what happens on engine flying hours. So one that's harder to predict, but a little bit of a shift to the right around that. On time and materials, you're right, the fall is there, but there are, again, less flying is going on, which means fewer of T&M type shop visits. Also, V2500 is a little bit lower around that.
And on the OEM break-even point, yes, you're right. Disruption caused last year made it very difficult for us to continue sort of reporting that because obviously there were large chunks of unrecovered cost. We will try to provide some guidance on that with the full year results, but certainly our ambitions haven't changed. And it's a question of volume, and of course the restructuring will give us a significant tailwind in that regard.
Okay. Thank you very much, guys. Thank you.
Thank you. The next question comes from the line from Charles Armitage from Citi. Your line is now open.
Good morning and thank you. A couple of quick ones. First of all, going back to Jeremy's question, wide-body market flying hours will recover whenever it does. But if you compare Rolls-Royce to the overall market, you've got a younger fleet, you're delivering more engines than you have compared with your market share on the fleet, and you've got fewer old engines to retire, so that should grow faster. But on the other hand, you don't have the freighter exposure. So do you feel that Rolls' large engine will recover faster or slower than the wide-body market as a whole? That's my first question.
Yeah. It's a slightly loaded question, isn't it? And the answer is the correlation that we saw last year between what's going on in the industry at large and recovery of usage of some of our engines. I think that holds going forward. It holds as far as things like our XWBs are concerned. Very pleasing utilization of some of those. You're right in terms of freighters, older aircraft. We are now seeing freighter conversions, passenger to freighter conversions going on with A330s and so on. And again, because our engines are the younger models of those aircraft, then I think there is a favourable tailwind for us. And obviously, as I said in answer to an earlier question, we're delighted with the Airbus dedicated freighter announcement. So broadly correct. We would expect to be on the positive side of a recovery trajectory.
Great, thank you. Second question is EFH pricing. As I understand it, there's a matrix dependent on how far the routes are and whether they're hot and high, etc. Now, as I understand it, the stage length has come down, which would imply that the price per hour should be going up. Yet, we haven't heard anything about that. Is that one of these long-term benefiting kinds or trading short-term for the long-term, or is it not coming through, or what's happening on that one?
Yeah. I think intrinsically you're absolutely correct. It's quite hard to see that coming through in the overall numbers. We'll take the point on and see if we can throw some colour on that with our full year results. But you're absolutely correct in terms of the principles that you outlined there.
Okay. And the final question is, we were sort of agonising over this in 2019, and it seems to be rather less important in the whole scheme of things. But the Trent 1010 HPT the fix was due to be certified around mid-year 21. I saw a 24 million increase in the provision. What's happening on that one?
Yeah, I think, as we sort of indicated at our full year results, that certification has been pushed out. We don't have that certification yet. We are expecting that certification before the end of this year, but in the detail, the FAA and their relationship with Boeing, they've had a lot of other things to do, basically, and certifying our Trent 1000 blades is a bit lower down on their priorities than it was when we made our original estimates. We are confident in the parts, and we're already making the new parts to fit when we do the overhauls, just as soon as that certification happens. And we're expecting it just before the end of this year, probably.
So from the Rolls-Royce perspective, it's the technology work is done.
Yeah, it's all complete, and we're in the queue, as it were.
Right. Lovely. Thank you very much.
Thank you. And our last telephone question comes from the line from Celine Fornaro from UBS. Your line is now open.
Good morning. Thank you for taking my questions. I've got two, if I may. The first one would be trying to reconcile the second half of last year performance with the first half of this year performance, and trying to reconcile a little bit, or maybe you could help me with that, on the profit bridge and the cash bridge, because clearly there is a strong improvement in the profit, even if I put on the side the 166 million and TSA contract recognition, but we don't really see that from a cash point of view. So maybe you could help us on the moving parts, understanding what is the restructuring, contribution, or the flying hours, and other things there. And then my second question would be regarding, I think we haven't really touched about, but certainly encouraging H1 performance. But how do you think you compare yourself versus other industrial businesses who have had really strong H1 results? And so what could you change in power systems there, or is it just very heavy H2 way? Thank you.
Thanks, Lee. I think on the first one, I suggest we take that one offline and we can take you through that outside of the call.
And on the second one, around power systems and some of the power systems competitors, I think you have to look at the power categories where those competitors have seen a strong rebound in the first half, and we're not actually in those power categories, which is why we haven't seen it in power systems. But what we have seen is a near 20% uptick in orders. And so, we are seeing a rebound, but it's probably 6 months or so behind that some of those competitors have seen.
And thank you, Warren. But in terms of the profitability of 3.5%?
Oh, well, I mean, that is a result of, a whole lot of factors. And, it's basically less revenue actually going through with the same cost. And obviously because of some of those competitors, as I said, have seen the impact some 6 months or so ahead, then that will be reflected in higher profitability.
And I think you'll have seen in the past it's a second half weighted business. So margins we're expecting for the year are in line with our previous expectations.
Thank you.
Thank you, Celine. And it's Isabel here. I've got one question that came through on the webcast just to finish up with, which is for you, Panos, and it's from Rory Smith with Investec. He's asking if we can talk a little bit more about the steps you've already taken to simplify reporting, and what you expect may change in terms of key KPIs that we produce, and how we're going to improve our reporting going forward.
Yeah, I think it's early days at this stage. What we've tried to do with this half is try and take a little bit out of the noise between statutory reporting and underlying reporting. So you can see that's been simplified. Then looking at the underlying business drivers, how do we get a better understanding of how those flow through the financials? And there is more to come particularly as we look at hedging and foreign exchange going forward. But that's a bit more of a medium-term project.
Thanks, Panos. And so back to Warren to close the call. Thank you everyone for their questions today.
Yes, thank you all. Just the quick summary to take away is that we're delivering on commitments made here. Restructuring is on track. The disposals program is going well. We are seeing significant improvements in profitability and our cash flow. And again, a continued position of strong liquidity and that journey to net cash in the medium term. And that's enabling us to have some confidence around the disciplined investments that we're making in the future, in our low-carbon businesses, which will be incremental incremental to our business as it exists today. So with that, I'll finish, and we'll be back to tell you about our full year results in due course.